Hey folks, glad you could join us on yet another episode of Business Redefined. This is your weekly, most comprehensive look at the world of business, finance, and economics. Now, the guest we have on set hasn't been on set with me for about 2 years. Angela Okinda, always a delight. Now, managing director for Equity Insurance Group. Karibu sana.
Asante, Julian.
And welcome back, Angela.
Thank you.
How's it been?
It's been exciting.
Wonderful.
Yeah.
Let's talk about everything pensions and also straddling a bit of insurance. So let's start from the pension side. I'm curious as to what you are seeing on the landscape. There's a lot of conversation around deepening the penetration, especially zeroing in on the vast informal economy. Are we moving the needle? What's your assessment?
Right. Well, I think that the pension space has been quite busy. As you know, Julians, we did have the NSSF Act that was really focusing on increasing contributions. If you look at national pensions, we actually had in the 80s just a minimum contribution of 80 shillings for an employer and employee, and then that was then increased to 200 shillings, which when you look at the retirement goals and the lifestyle that an individual needs was quite a low level of savings. So the NSSF bill was targeting to increase contributions, but admittedly, it was introduced at a time when a lot of employers were struggling with costs of business. And so for about 10 years,
A whole decade,
yeah, the NSSF Act was on freeze, and we actually saw it being reintroduced. Now, what we've seen, and if you look at just 2024 alone, there's been a significant growth in terms of the contributions, over 100% growth in terms of contributions, and a large proportion of that is driven by the NSSF Act. However, what has interestingly happened is the number of contributors has reduced because with the increase in costs of employment, some employers have found it difficult to retain their employees and have made the difficult decision to take them back to a different form of contract. So it's been positive in some ways, but because of the growth of the economy and the cost of running a business, we have seen that the overall number of savers has suffered a bit of a decline. Now, from where we sit, we believe that a government will provide policy and act to enable us then to have an enabling environment, but it's a fantastic opportunity for private sector to then innovate new solutions that will then deal with, particularly, as you said, the 80% informal sector who are not reliant on a monthly salary, are basically running their own businesses, and at some point will need to retire. And I think that's really the baton that the private sector needs to take on in terms of providing additional solutions that the mass market can really consume.
But how much of innovation can we really come up with on this side as a private sector? Because we had the Mbao pension plan. Government will tell you we have tried to ramp up this product. Uptake is still abysmal. Many are asking, when you look at the returns being given by the NSSF fund, not as compelling. What gives here? How do we actually bring in this segment of the population now into the net of pensions?
Yeah. Well, it's been very interesting, my journey here at Equity, because when I joined Equity, it was really about transforming lives and using financial solutions for which we are trying to use pensions and insurance to do that. Yeah. And what's been interesting for me is to have a real understanding of who is this customer. I'll tell you, Julian's, in the period that I've been here, I believe I now have a true understanding of what an SME is. When you look at the way the industry is structured in terms of even just the governance, the onboarding of an SME. When an SME is being onboarded onto a pension fund, they need 8 to 10 different documents. The reality today is the MSMEs in the market do not have board resolutions.
Yeah.
They do not have the structures that are necessary to even be onboarded. And so it's been a fantastic opportunity to relook at if we're really designing products that are fit for customer, then there has to be an evolution. And what we've done now on the equity insurance side is realize that a lot of what had been structured was really fit for purpose for large corporates and not necessarily necessarily suitable for large-scale SMEs who really have a different focus in terms of business. And that's why I was talking about innovation, not just in the product design, but even in governance, even in reporting. You'll find, for instance, MSMEs would, yes, it would be fantastic to have an app, but most of them keep track of their businesses using a feature phone.
Yes.
Now, today, do we have platforms that provide reports and statements on feature phones?
Feature phones.
I kid you not. So I think we need to do more work as private sector to move closer to where the customer is. I think the industry, to be honest, has grown. When we last spoke 2-3 years ago, this was 18%. We're now at 25%. So there's been some movement. But I think that there's more work that players need to do to really understand who is that customer that you're solving for, because the investment vehicles could be there, the pension schemes and arrangements could be there, but is the product or service available to the customer at ease and convenience, which is really what we've been trying to do at Equity. So I believe there'll be more transition as more players understand the customer that we are solving more, and even as we continue to engage the regulators to explain to them who is our true customer. You can imagine an MSME is somebody who is the person who does smokies, right?
Yes.
So when we talk about onboarding that person with a board resolution, it's a
disconnect.
It's a bit of a disconnect.
Yeah.
But it needed an engagement partner such as Equity who really understands that mass market to then sit and say, let's work together and let's review what we've been doing and see how we can then design products that are fit for purpose and processes that truly support majority of the market. And I believe we're there.
And even as we appreciate that, indeed, Equity is one brand which you can say is built for retail in its DNA. There are those who would say, how do you curate solutions for the increasingly Gen Z population? And why are they particularly of interest? Because they are predominantly in a gig economy. They will tell you, you guys were used to standing orders. Every month is a deduction. We have irregular incomes and we don't care for regular incomes.
Yeah.
How then do we ensure we are meeting their need and those nuances as we design these products?
Yeah. So I think the youth is a very special demographic. As you know, being in East Africa, we have a huge demographic dividend. And any sustainable business is not just looking at solving for the current working class, but is also looking at solving for the consumers of the future, who are really the Gen Zs. At Equity, we do have Gen Zs as a special segment. And we spent a lot of time understanding, what is their ecosystem like? And it's other than the gig economy, you'll find that they're very keen on things like creative arts and sports as ways in which they will generate personal income. You'll find that they largely would want to be working with mobile wallets vis-a-vis bank accounts. And so what we've been doing is we've been ramping up our capabilities to speak to the Gen Z population, not just from capacitating them from a business perspective, providing them, for instance, with e-commerce platforms where they can trade, providing them with relevant payment solutions where they can, be able to trade their craft, but also automatically get reconciliations as business owners. So as Equity Group, we've designed solutions which are end-to-end, not just dealing with payment solutions, but even creating platforms for them. And in the coming days, are the things that you'll start to see. Now, on a savings platform, it's very interesting because, the Gen Zs believe more in experiences. They don't believe in having a fat bank account as a way of ensuring. In fact, one would argue, they say you only die once, while millennials said you only live once. So very different type of movement. Now, in my experience with Gen Zs, what we've done is we've gamified saving solutions. Naturally today, for instance, if you were to talk about a health insurance product, when you're talking with Gen Zs, they believe they'll always be healthy, they'll always be okay.
Yep.
So they will not naturally consume health insurance products. But any Gen Z right now would be working with 3 or 4 devices. And so talking to them about pay-as-you-go insurance for your devices, for your cameras, which is really what they like to do, is something that they relate with. So what we've done is to say, how do we gamify the insurance solutions we know they need? They might not want to buy them directly. And how do we create a solution where, for instance, we encourage you and say, if you save 2,000 shillings a month and if you retain your limit above that 2,000 shillings, then in there we wrap in an insurance solution. We also have solutions where we're now saying for Gen Zs, if you keep your minimum at 5,000 shillings or more, then the interest that you earn on that then becomes a long-term savings into a pensions product. As you know, a lot of people don't believe that they'll age. So this conversation about saving for the older person that you're going to become is not an easy one. Usually we find that when customers start to get to age 50, that's when the emergency for saving comes. But usually by age 50, your runway is quite short.
Yeah.
So we're no longer looking at retirement about being a point in time. I'm retiring at 60. No, in fact, usually we've seen now that at 60, you start a new career.
Yes.
And what we're now saying is retirement is about freedom and empowerment. And what we want our customers to do is get to a stage where you have enough money to decide what you want to do. Whether you want to wake up and work, whether you want to go on holiday, retirement saving is really about securing your financial freedom to live the life that you want to live in future, not so much about 60 years or 70 years. And we believe that that is really where we want to go in terms of empowering an individual to then make decisions about their future and having enough financial capability to then live the lifestyle of their choice.
Angie, I like the way you have segued there into insurance. And let me start with a very broad question. How is the general landscape looking from a general and life perspective? And I'm asking that because coming off COVID, the statistics I've been looking at suggest that the industry has been under enormous strain, especially when you look at it from a loss ratio perspective. Are you seeing it beginning to turn a corner, or how is the landscape looking?
Well, that's a good question, Julian, because as you know, loss ratios are usually a factor of two things. One factor is the actual claims that are incurred, but the other factor is pricing. So the insurance industry, particularly when you look at large ticket insurance portfolios, we have systemically been underpricing. And as a result, when we underprice the risk, then even when you have a reasonable loss or claims incurred, it presents itself as a high loss ratio. Now, the Association of Kenya Insurers and some of the reinsurers for certain products have been attempting a reprice. For instance, you look at motor, where even the regulator came in and said, we want to ensure that everyone is pricing at 7, but the market is pricing at 3. And customers in an environment like this, where, there's a lot of fiscal pressure, are very sensitive to increases in price.
Correct.
So there's a journey that the insurance industry is going to take in terms of actually doing risk-based pricing. Because the reality is when we don't do risk-based pricing, inevitably as an insurer, you're not able to sustain a claims ratio, leading to high rejection rates.
We're just undercutting each other.
Exactly. So there's a bit of our own culture as an insurance industry and us moving to risk-based pricing and being able to tell customers that, look, we've priced you at the right level for your risk. If you are a very risk-averse customer, you present at a very low risk level, then you get lower rates. But perhaps if you have a much more exciting lifestyle, and risk-seeking behavior, then we should charge you something different. And remember, it's not about restricting your lifestyle. It's just about charging you the right premium.
2 follow-up questions there, Angie. The first one is, you've touched on 2 very important things. One is risk-based pricing and the necessity of it in the market. The second one is the strength of the balance sheets. Is the transition from IFRS 4 to 17 possibly the trigger for the kind of change you're talking about? Because one, of course, the way in which you take on your loss is recalibrated. Secondly, is there a case for consolidation in the insurance sector? Because as you said, many fragmented players, our core business is undercutting one another. Is there a case for consolidation?
A good question. Let me start with IFRS 17. IFRS 17 is, in my view, one of the best standards because under the IFRS 4 format, it was very difficult for an investor to ascertain what is the true performance of the business. And largely what we saw is most insurers were reporting profits, but those profits were coming from investment income and not the core underwriting business. Now, when you look at IFRS 17, it requires you to not only report the true performance of the business. But as you rightly said, it requires that when you're onboarding a risk, particularly when you are aware that this is an onerous risk, onerous being a contract for which the loss ratio is likely to be more than 100%, then as an insurer, you're required to take that loss upfront, which a lot of insurers are not likely to do. So it is intended to drive the right behavior in terms of visibility and transparency, in terms of what's driving the performance, but also intended to introduce the right practices around pricing. Now, being its second year now of adaptation within the industry, I think we've seen a mixed bag. The first year of any standard is always challenging, and there are elements where we're still debating as an industry, how do you classify, because we have different measurement methods of the risks on the book. So we still have, as you would expect, even when IFRS 9 was introduced, there was a cycle of 3 years.
The banking sector was.
Exactly, in a disarray. And so we've seen, I would say, a reasonable level of adaptation, but we're still going through an element of refinement in terms of aligning that. And of course, Julians, you do know that for any insurance business that was new, it was good. But for a lot of insurance businesses that were in existence before that, there was a significant level of work in terms of going back to the historical policies and reclassifying them. So IFRS 17, I think at its maturity, will actually be positive, because then it will be possible for an investor to ask management in the board the right questions around strategy, around pricing. And if we do continue to undercut, there will be a very heavy price from a capital perspective, which we believe then the investors would not be comfortable with. So IFRS 17 is a great plus. And for me, it then introduces a level of comparability. When you're looking at financial statements of 3 or 4 different companies, it is possible to reasonably assess and compare that performance. So it really empowers the consumer. Now, consolidation. So when you look at the number of insurance companies being set up in Kenya, there are few. And when we engage with the regulator, it's for the same reason that you've mentioned. We have over 68 insurance companies in Kenya. Chileans, we have over 200 brokers, and we have over 12,000 agents. Now, that type of infrastructure, vis-a-vis the penetration we have, definitely means that there's somewhat.
Are we still at 3%, by the way?
We're at 2.3%. And actually, what's been happening is we've actually been reducing as a percentage of GDP. About 5 years ago, we were at 2.7%. Now we're at 2.3%, which tells you that the industry is growing slower than the
economy.
GDP. Exactly, which is a big concern, considering the fact that insurance is a need. It's a day-to-day need. So from where we sit, some of the reasons that would support consolidation is right now we've talked about the need to focus on rejuvenated products to target Gen Zs. Some of those initiatives require significant investments in IT systems, in platforms. When you have a consolidation, then you can have more capital to then focus on some of those strategic initiatives that can help us design outside the construct that we've been working with. We do see a possibility that there could be mergers. But from where I sit, I think the bigger challenge for us as an industry is how can we move that needle?
Angie, how do you navigate the cultural rigidities? And here's where I'm coming from. I know of people who want no conversation about a last expense cover. Never mind, we are all in WhatsApp groups for fundraisers, for burials. Yet the market has designed a solution which can actually take this burden off you. I know that's a bit of a difficult one, but how do you go about it? Because this product, if it's to sell, it must bridge that difference between the cultural perspectives.
Yeah. Well, it's very interesting you mentioned that about change, because just today morning, I was reading musings around the changes in burial customs, where before, in certain communities, for very prominent people, we would see, a very extended period, 2 weeks, 3 weeks, very expensive burial. And we are now in an era where the same prominent people are saying, within X number of hours, I want to be laid to rest. And I believe with any change, there have to be those pioneers who then say that we're going to set a different precedent, and because we're influencers in the community, then we can start to drive that change. Because adoption of a last expense is not an easy thing, because it means telling somebody that today I'm putting money aside
For you.
for you to put me to rest. In some communities, it's even taboo.
Yeah.
They say that affairs of your death can only be discussed when you're dead and gone. So my belief is that we need change agents who are influencers to have these open conversations. By the time you see some changes in burial customs, and you definitely see the shock that it comes with.
Yes.
How could it be 72 hours? How could somebody say they need to be cremated? But the fact that we have significant people now looking at the cost and the burden of some of these things and saying, no, surely there's a better way it can be done. I think we need a few more people to lead the charge, a few more people who are influencers in the community to have these conversations. And I believe with that, we're going to get some momentum.
All right. Ajay, I can't believe Agatha is already dialing me down on time. What, what policy imperatives would you put forward, especially around insurance and the question of the lethargic penetration? Because I can't believe we used to talk about 3%. We're at 2.3. I mean, granted, someone could argue it's the denominator which is growing very fast, but surely we need to do something there.
So from a policy perspective, last year we saw a lot of changes with respect to pensions and the tax regime. I think by and large that was very well received. But I think at the moment, one of the things that has created a bit of a constraint is the economic environment. As we speak today, insurance solutions are still considered to be a luxury. And when you look at the day-to-day spending for what you need, your current expenditure, you'll find the day-to-day East African is struggling. And so while, yes, we can talk about reform in terms of the Insurance Act, in terms of the Pensions Act, the current market is struggling with disposable income, directly related to the overall tax with respect to disposable income, which I think would create some legroom for consumers to start to take up these additional solutions that they're looking at. Now, we do know that from an investments perspective, pension funds for a long time have been approached with respect to investing in some of their long-term infrastructure initiatives, whether it is the public-private partnership on Mai Mahiu, whether it is supporting the National Housing Initiative. All those are long-term investment initiatives which are required or would do well when you have patient capital coming from pension funds. Now, Julian's pension funds are managed by trustees.
Yes.
These trustees have a third-party responsibility to members. And so when we create these investment vehicles, giving boards of trustees comfort around the governance of those vehicles, giving them sufficient guarantees around the performance of those long-term vehicles, and to some extent, being able to guarantee a suitable hurdle rate,
Yes.
then would make it easier for pension fund trustees to quickly finance or promote funding for some of these long-term initiatives. So the capital is there. The industry is currently sitting at 2.3 trillion in assets.
Yes.
We're sitting at 60% in government securities. There's an opportunity to diversify that further. So whether it is a policy change in terms of how these instruments are structured, the capital is there. It's just about providing boards of trustees with a comfort around the structure, the governance, the returns, because inevitably they are responsible to the members for whom they've been entrusted with funds over the long term to get into retirement.
Anjay, I asked that question to a trustee and they asked me, if an IFB, an infrastructure bond, is giving me 18%, who on earth would be looking at other assets?
Yes, exactly. Exactly. And what I found very interesting is that the level of accountability for members of pension funds has really increased. Members now don't want an annual benefit statement.
Yeah.
They want to get their app and they want to log in and see their statement. They want to see that when money was deducted from my payslip last week, that my pension fund administrator credited it. So the level of accountability that members have now over their funds is increased. And so it means that a board of trustees has an increased burden in terms of transparency, accountability, and returns. You and I know getting an instrument to give you 18% is not easy.
It's not easy.
And so even as we look at diversification, I think there's an opportunity for us to do more around deepening the capital markets, providing alternatives for pension funds, because diversification is necessary for risk management of pension funds, but perhaps there's more work that we can do around creating suitable alternative investments that boards of trustees would be comfortable with.
And unfortunately, we have to close it here now. The final question is this. It's actually a pitch question. So if I'm a viewer, why should I be thinking about equity and its subsidiaries in this space, in insurance and pensions, as my go-to point?
I think one of the things that Equita does really well is partnership with its customers. A lot of what we do as our DNA when we talk about our bid to transform lives is really to look at what the customer problem is. As you know, Julians, the story of Equity is democratizing banking and being able to migrate customers from banking in the mattress to having actually digital accounts. The story for insurance is not any different. I think there's been significant effort by players in the industry to move the needle. But I would say that not many players have the DNA or the construct of Equity, which is, number one, very customer focused. Everything we do is around solving a problem for the customer. And so what you find is in a lot of our insurance policies, what a standard insurer would treat as an exclusion, we don't treat as an exclusion. In fact, what we do is say, just tell us what your risks are, we'll help you de-risk and we'll price it. You'll find, for instance, when we're looking at some of the products such as our education policy, we don't have a surrender value. And those are some of the things, yes, those are some of the things that customers have been unhappy about. And they say, look, I get into a contract with an insurer, and when I want to exit, the penalty is so heavy, I get unhappy. We've been able to design policies that do not have surrender values. So a customer then at any one time when they take on your product, even if they choose to sunset the policy, they will never get anything less than what they gave you, plus a minimum guaranteed rate of return.
Unfortunately, that is where we have to leave this conversation at, because my boss, Agatha, is really keen on how we progress with this matter. We've been speaking to Angela Okina on everything insurance and pensions, and of course, covering the landscape in broad scale and telling you what Equity Group is doing in this particular space. Keep it business redefined for all the things as and when they happen. Stay tuned.